Q&A so that I know whether you are there. Yes, good evening. Good. I can see quite a number. You are there. This is good. This is good. We can therefore start. Communicate with the others who have not arrived so that we start. We are at 50%. We have the class, so just communicate with the others. And I think the important thing is we go direct. I can see everyone who is in is responding. I hope you can see my screen. You can see my screen. There is this illustration that we left last time. I want us to wind up this topic. This illustration that I left last time, we look at it briefly so that we can wind up this topic. Open the question on your end. Just open so that you can look at it. Okay. I want us to start with that question so that as the others join, we can move with the other business of the day. If you have opened yours, or you can see my screen, we read together. For those who attempted and sent me the question, I think it is good we confirm together. I want to read. Huge Limited is contemplating a complete share acquisition of Tiny Limited. Huge Limited is offering 3 of its shares for every 2 shares of Tiny Limited. The data relating to the 2 companies are shown below. Huge Limited, Tiny Limited, earnings to ordinary shareholders for each of the 2 companies. We are given EPS, MPS, then the corporate tax is 30% required. Number A, determine the maximum offer price that will not dilute the EPS of the Huge Limited. B, compute the premium payable to the shareholders of Tiny Limited. C, given that the growth rate of Huge Limited is 8%, or that of Tiny Limited is 12%, compute the combined growth rate of the 2 companies. Let us look at it. I hope you can clearly hear me, and we see how to go about this question. Number 1, determine the maximum offer price that will not dilute the EPS of Huge Limited. Non-diluting offer price. Non-diluting offer price is equal to EPS of the target divided by the EPS of the creditor. So that way, offer price. So let's look at it. EPS of the target is 29.25. You divide by this is not offer price, exchange ratio. How did I do that? Non-diluting exchange ratio is equal to 29.25 over 14.8. Can someone give us that? Someone to solve that one for us. Someone to put it in the calculator, give me the simplified. 1.976. 1.976. That is the non-diluting exchange ratio. So the question is, what is the non-diluting offer price? How do we get the non-diluting offer price? Someone to give us the non-diluting offer price. If you can look at it from here, we did the non-diluting offer price. Let me get you to that so that we can remember. Exchange ratio is the target EPS before merger. Predator EPS before merger. That's what we've done. I want us to get to non-diluting. Non-diluting exchange ratio is okay. Non-diluting offer price. Now, I want us to look at it from this perspective. We said that exchange ratio is equal to the offer price by the predator per target share over the market price per share in the predator company. That's the exchange ratio. The non-diluting exchange ratio is the target EPS before merger over predator EPS. So if we need non-diluting offer price, that's what you are looking for. The non-diluting offer price is equal to the price earnings ratio by predator before merger times EPS of the target before merger. So we need to get, the question is the offer price, this one, non-diluting offer price. It is the price earnings ratio by predator before merger over EPS of the target. That's what we need to determine here. We got, this is non-diluting exchange ratio. We need non-diluting offer price is equal to price earnings ratio of the predator. You multiply by the EPS of the target. So can we determine the non-diluting exchange ratio? What is the price earnings of the predator? Price earnings ratio of the predator. Price earnings, MPS over EPS, 222 over 14.8.
Recording in progress.
So I'll take 222 to divide by is set 14.8. We multiply by the EPS of the target, which is 29.25, 29.25. Let us, someone give us this, please. That is a 14.8, yes, 222, you multiply by 29, yes. How much is this, please? Let us check. Give it. Someone is giving 438.75. Can we confirm? 438.75. 438.75. Is that confirmed? Let us see from another person. 438.75, 438.75. Good. That is the non-diluting exchange ratio. If you are told to determine the non-diluting of a price, that is non-diluting of a price. If you are required to determine non-diluting exchange ratio, this is the way you go about it. Now, question number 2, compute the premium payable to the shareholders of Tiny. Premium per share is equal to offer price minus MPS is equal to the offer price minus MPS. This is the offer price by the predator. We minus the target. MPS. How much non-diluting offer price is equal to 438.75 minus how much is the market price per share of the target? The target shares are expected to sell at 322. What is the meaning of this? It means that if one share is selling at 322 and the predator is buying your share at 438, then it means that you have a capital gain on acquisition, which is called the premium. How much is it? Let's get it. Let us have someone to give me the figure. Someone, 438.75 minus 322. 116.75 confirmed. $116.75. Then we say that total premium is equal to premium per share. You multiply by number of shares in the premium. In the target. This is equal to the premium per share is 116.75 multiplied by how many shares are there in the target. For every share, now we need to determine the number of shares. We are given earnings to ordinary shareholders, earnings per share. Now, we determine the number of ordinary shares. Number of ordinary shares is equal to, we try to relate this, is equal to, remember EPS is equal to the earnings to ordinary shareholders divided by the number of ordinary shares. So can we therefore say that this is earning to ordinary shareholders, we divide by the EPS. To get the EPS, we did the earnings to ordinary shareholders divided by the number of ordinary shares. So now we need to get the number of ordinary shares. So this one will give us by is equal to earnings to ordinary shareholders in the target. This is the earnings. This one. You go down there. Give it that way. Divide by the EPS. No, is that correct? Is this correct? Is this correct? Earnings to ordinary shareholders divided by the EPS. Yeah, so this one is how much? This is 29.25. 29.25. How much is the number of ordinary shares? Someone to give me this. Uh, 80,000. We have 80. 80,000. How much is there for the total premium? Total premium is therefore equal to total premium is equal to multiply by 80. How much is the total premium? Someone to give me the total premium. $93.40. Can you find out whether this is correct? $93.40. $93.40. That is what I see from the majority of you. So $93.40. That is the total premium. Number 3. Given that the growth rate of Huge Limited is 8%, while that of Tiny Limited is 12%, compute the combined growth rate of the two firms. Combined growth rates. Combined growth rate. Number 3, we say that combined growth rate is equal to growth rate, predator growth rate times predator growth rate times the earnings, predator earnings plus the target growth rate, you multiply by the target earnings, like that. So I want to put it there so that I can fit the formula, divided by the predator earnings plus target earnings, like this. Then you multiply by 100. You multiply by 100 to make it a percentage, like that. Now, if this is the case, we are told that given that the growth rate of H is 8, its earnings is how much? Is this one. So I'll take, here we are, 8% multiplied by, we add 12% multiplied by, we take the earnings for the target. Remember, I'll be dividing this one, so I should have it there first, like that. Then I'll come and pick the earnings of the target, like that, that way, that way, that way. Good. Then whatever we get there, we multiply by 100. Let me get it from someone, please. Someone to give me the answer for that growth rate. Growth rate equals. Growth rate equals. Growth rate, growth rate, growth rate. Someone to give me the growth rate. Someone is asking a question. Why didn't we use the exchange ratio of 3:2 per question? Let me go back to the question and see what you're asking. Okay, first give me the growth rate. Give me the growth rate so that we can respond to questions. Give me the growth rate. 9.24%, 9.24%, 9.24%. Then if you have a question, ask the questions as I respond to this one. The question someone is asking, oh, did it disappear? Why didn't we use, I think, 3.3? Is it 3:2? Why didn't we use the exchange ratio of 3:2 as per the question? The exchange rate of 3:2. Where is that exchange rate? We are told that H Limited is contemplating a complete share acquisition of Tiny Limited, which is offering 3 of its shares for every 2 shares of Tiny Limited. The data relating to the 2 companies are shown below. The question is, determine the maximum offer price that will not dilute the EPS of Huge Limited. Compute the premium payable to Huge Limited, to the shareholders of Tiny Limited. Oh yeah, I see where you are coming from. Compute the premium payable. Okay, I referred to this, by the way. I referred to question 1. I ignored this question. Huge Limited is offering 2 of its shares for every 3. Yeah. I agree with you. I completely agree with you, and thank you for that correction. Thank you for that correction. I used the non-dilutive. They have the exchange ratio. I think you are referring to this part. you must be referring to this part. This part, this part, this part. Sure, sure. I agree with you. So this should be number 2. Number 2, we are told that the exchange ratio is equal to 3:2. 3:2. 3:2. That is the exchange ratio that we are given. So we need to determine the offer price. The offer price. Offer price. Offer price at exchange ratio. Exchange ratio of 3:2. Of 3:2 is equal to, we have the exchange ratio. We know that the exchange ratio is equal to the offer price. We have the offer price and we got the exchange ratio. The exchange ratio is equal to the offer price by the predator over the market price of the predator. We say that offer price, offer exchange ratio is equal to offer price by the predator divided by the MPS of the predator. So the question is, if you have the exchange ratio 3:2 is equal to the offer price divided by the MPS of the predator. MPS of the predator is how much? Market price per share is 222. Is 222. 222, like that. So we can therefore say that offer price is equal to the exchange ratio 3/2 we multiply by 222. How much is this? Someone to give me the offer price. It's 333? Yes. They are offering 333. So how much is the premium as per the offer price, not the maximum? 333 minus 322. I believe it is 11. Then here we multiply by 11. This one, 11. How much is it? That was a good thing. The noting that was very good. We can always make mistakes as human beings. Is it 11 or 111? Someone has said 111. I think it is 11. It should be 11. Okay. How much is the total premium? 11 times 80? Is it 880? Confirm. 11 times 80. Yes, 880,000. Someone has said 880. Another one 880. Good. That is the total premium. It doesn't have any relation with the next part of the question. It doesn't have any relation with any other part. So the mistake could have only occurred on that. Good. I want you to ask a question before we go to our past paper question. I want us to wind up this topic from the questions in the past paper. Question, any question? If you do not have a question, we move to the past paper together. August 2024, question 4. August 2024, question number 4. August 2024, question number 4. This one, the August 2024, question number 4. August 2024, question number 4. Open, let me know when you have opened, please. August 2024, question number 4. If you allow me, I can stop displaying this one. I display the question instead so that you can look at it together. August 2024, question number 4. Are you there? Let me know whether you are there, please. I need to know whether we are there. Are we there? Are we there? Someone says yes. Let me know whether you are there. We move. I need to know whether we are there. I only see one person say yes, so I don't know whether the others are there. Please, can we confirm whether we are there? Yes, please. Yes, please. Have we gotten there? Good, good, good. I see quite a number on that question. I want us to read through it together. We read through the question together. If you can see it on my screen, I can read. The question, August 2024, question number 4, acquisition proposal. I read. Isonga Limited IL is a listed company specializing in the manufacture of leather products for more than 2 decades. It produces a variety of products such as bags, shoes, belts, carpets, wallets, gloves, and cushions. They are seeking to use advanced technology in producing and designing such products. ML's cutting-edge technology has attracted the attention of the directors of IL. IL is considering acquiring ML with a belief that it will use its technology to expand and be able to compete with the similar companies in the market. The company's performance in the past year has been building. The share of ML is 15 million, priced at Rwandan francs 10.5 each. ML's market value of the beta is 1.54. The risk-free rate is 10%, and the market required rate of return is 12%. The directors of IL have projected the performance of ML for the next 5 years based on the post-merger cash flow as follows. The projected post-merger cash flow as of December 31st in Rwandan francs, GAWSATS, quote, year 2025 through 2029, we are given the sales revenue for year 1, selling and administration expense for each year, depreciation for year 1 only, interest expense for each of the 5 years. Other information, number 1, The finance director has projected the sales revenue to grow at 10% per year for the next 4 years. 2, variable costs are 40% of the sales revenue. Number 3, fixed cost will be 15% of the sales revenue. Number 4, depreciation is expected to increase by 10% per annum. Number 5, the operating profit was arrived at before deducting depreciation. Number 6, ML is expected to grow by 10% per annum to perpetuity after the 5th year. Number 7, ML will retain an amount equivalent to Rwandan francs 20,000 for internal expansion for the first 2 years and Rwandan francs 15,000 for the rest of the year. For the rest of the years. Number 8, corporate tax rate is 30%. We continue. The relationship between managers and shareholders. One of the theories that have been pointed to explain why acquisition fail at a higher rate is agency theory. Shareholders of the target firm believe that the acquisition is in the interest of the managers of the acquiring firm. The shareholders of IL believe that the acquisition of ML will enhance the value of the company through expansion of the market, improvement in sales revenue and reduction of costs. The management of ML may act in the interest of the shareholders by taking defensive measures to protect their company to resist the acquisition. This might be done by maximizing the sale price of the company. You as an expert have identified a possibility of agency problem between the principal that is acquiring firm and the agent, which is the target firm. Required. A, you have been approached by the directors of ML to advise them on maximum amount that they should acquire IL, 20 marks. B, explain to the shareholders of ML the concept of agency theory and discuss to them 2 cases and do solutions of agency problem. 5 marks. Now, good. I want to give you 5 minutes. 5 minutes. Read at your pace. Read at your pace. Read at your pace. Try to understand it. Then we look at it together. Please read. I will give you 5 minutes are enough. So assuming that everyone has read through the question, let us work on it together. As I said earlier, always read the question until you understand. Read the question until you understand. I want to read through it so that we can answer part 1. Acquisition proposal. Isonga Limited IL is a listed company specializing in the manufacture of leather products for more than 2 decades. It produces a variety of products such as bags, shoes, belts, carpets, wallets, gloves, and cushions. They are seeking to use advanced technology in producing the design and designing such products. ML's cutting-edge technology has attracted the attention of the directors of IL. IL is considering acquiring ML with a belief that it will use its technology to expand and be able to compete with the similar companies in the market. The company performance in the past year has been dwindling. The shares of ML is 15 million, priced at Rwandan francs 10.50 each. ML's market value of beta is 1.5. The risk-free rate is 10%, and the market required rate of return is 12%. The directors of IL have projected the performance of ML for the next 5 years based on the post-merger cash flow as follows. We are given projected post-merger cash flows as of December 31st. The currency is given in Rwandan francs. Year 2025 through 2029, we are given the sales revenue, that is 102 in year 2025, selling and distribution expenses for each of the 5 years, depreciation for year 2025 only, interest expense for each of the years. Other information, number 1, the finance director has projected the sales revenue to grow at 10% per annum for the next 4 years. Number 2, note that that is about the growth in sales. Number 2, variable costs are 40% of the sales revenue. Number 3, fixed cost will be 15% of the sales revenue. Number 4, depreciation is expected to increase by 10% per annum. Number 5, the operating profit was arrived at before deducting depreciation. Number 6, ML is expected to grow by 10% per annum to perpetuity after the 5th year. Number 7, ML will retain the amount equivalent to Rwandan francs 20,000 for internal expansion for first 2 years and Rwandan francs 15,000 for the rest of the years. Number 8, the corporate tax rate is 30%. Let us leave this section because this one relates to part B of the question. We go to required. You have been approached by the director of ML to advise them on the maximum amount that they should acquire IL, 20 marks. I want someone to write on the Q&A. You tell me which method are we going to use to value? Which method should we use to value this target? Which method, based on the information provided, which method are we going to value the target out of all the methods that we covered? Someone can tell me which method are we going to value as I display an Excel sheet. I want to use an Excel sheet to solve this question. So allow me to display an Excel sheet. I will use an Excel sheet so that you can move fast. Yeah. Can someone write and tell us which method are we going to value this entity out of the methods that we covered last time? Let me see what people are saying. Someone says cash flows. Another one says discounted cash flows. Another one says NPV. Did I see something like that? Cash flow, discounted cash flow method. Good. It is the discounted cash flow method. I know those who are saying cash flow, they meant discounted cash flow method. Good, 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 good. The turnout today is good. 99 participants. I had seen 100. This is encouraging. This is encouraging. I want us to report 100% pass. Please. I want us to report 100 pass rate out of 100. I want you to engage me until we get 100%. This is my target. It is not my first time to report 100% pass. And if you want to know that, ask the BBA CASNEB students in Rwanda. Also ask performance management students in Kenya. All my students, I have reported not once 100% pass. So I don't expect anyone to fail this paper. Please make sure that you attend all the classes. I can guarantee you, you will pass. Good. Now, let us go together. This is, if you can see my Excel sheet, please let me know. Can you see my Excel sheet? In the exam, you will arrange your work, but I want to use the Excel sheet so that I can make things easier. I can make work easier. If you can see, yes, good. I can see you are responding. Good. I want to do this because, okay, I know I would have used the direct board contact, but just allow me to try and get these figures from the question. If you have a calculator and your pen, you can press them, but now let me just type. I will give 2025, 2026, so that I am using Excel sheet so that we can move fast. 2020 through 2028. Then there is something I need to do somewhere here. I want to make it in currency format. Good, 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 like that. Now, from the question, I'll start with sales revenue. Let me pick, oh, sorry. I want to copy and paste instead of typing. I will, that is sales revenue. I hope you can see it on your screen. I'll go to selling and administrative expenses. It will be fast, don't worry. I want to do depreciation. I have the depreciation. I have the next item is interest expense. I'm picking them from the question, the way they are given in the question. I want to arrange them well, like that. I hope you can see them. They are clearly visible. Now, from the question, we are told that the sales revenue is 102. I will just put it the way it is, 102,000. I will want to give selling and distribution 12, 13, 14, 16, 19. 12, 13, 14, 16, and 19. In case I make a mistake, please don't hesitate, just correct me. Depreciation is 700. Depreciation is 7,000, not 700. I have Interest expense is 56788. 5, 6, 7, 8, 8, 8, 8, 8. I hope that is how it is. Please, if you note a mistake in my typing, you can always let me know. Now, having done that, I want us to go down here and, but what am I doing? I should have said, determine the annual cash flows. Determine the annual cash flows. Determine the annual cash flow. Determine the annual cash flow. Like this. Let us go to note number 1. The finance director has projected the sales revenue to grow at 10% per year for the next 4 years. To grow at 10%. How do we grow it here? It is equal to 110%. We multiply by the previous year sales. For each of the years, you multiply the previous years with 110% because the growth rate is 10%. Note number 2, variable costs are 40%. Variable costs. We ought to have left the space for the variable costs. I will leave some space for the variable cost here. Variable costs at 40%. At 40% of sales. This is equal to 40%. We multiply by these sales. Like that. Allow me to make it negative, being a cost. That way to the end, I will make what we call the contribution. The contribution, this one is equal to the sales minus cost of sales. This gives me the contribution like that. We move on. Fixed cost will be 15% of the sales. Fixed cost. Apart from the administrative expenses, we have fixed cost. Fixed cost is equal to 15% multiplied by the sales. I can put a negative sign to mean that you are deducting. Then I'll make it like that. Good. That is fixed cost. Fixed cost is 15%. That looks good. I should also have introduced the negative sign here. I also should have made this one negative. It is a cost. This one I make it negative. It is a cost. This one I make it negative. It is a cost. And this one I make it negative. It is a cost. Good. Then we are continuing with the additional notes. Number 4, depreciation is expected to increase by 10% per annum. Increase this one by 10%. So we say that it is equal to 110%. We multiply by the previous year's depreciation. Take it to the end. But of course, we should have made it negative like that. That is depreciation. Good. Then we go to the question again. Depreciation. The operating profit was arrived at before deducting depreciation. Number 6, ML is expected to grow by 10% per annum to perpetuity after year 5. Now, before then, let us do this. Let me determine the operating cost. Operating cost, I'll bring the depreciation somewhere here. I will have my finance cost here. I'll say that this one is minus like that. Oh, sorry. What did I do? Like that. That way. This is what we call control U. This is what we call the earnings before depreciation and tax. That way. Earnings before depreciation and tax is this. Up to here. Then we come here. This is the earnings before taxation equals, we pick this minus depreciation. I'll take it that way. Then I'll push it there. Good. Let me see whether we have the tax rates. The corporate tax rate is 30%. Taxation, tax at 30%. This is equal to 30%. We multiply by this. We pick it across. We say that equals the earnings before tax, we minus taxation. That way. This gives me what we call the earnings after tax. We need cash flow, add back depreciation. We add back depreciation. We had depreciation somewhere here, so we will add back this depreciation, and whatever we get is cash flows. Annual cash flow. Annual cash flow. We sum up this. Annual cash flow. We'll have to make it like that. These are the cash flows that will be generated, and I hope we are together. I don't know whether anyone has asked a question. Maybe I need to check. Could there be anyone who has asked a question? Or maybe I left something and someone noted. Yeah, good. There are many questions. Oh, someone is asking which question is this. The question is April 2024, question number 4. Okay, someone is asking how we get sales in other years. We are told that sales is increasing by 10%. So it is 110% multiplied by sales for the previous year. Please, it is sales multiplied by 110%. Year 2026 sales is 2025 sales times 110%. Year 2027 is 2026 sales times 110%. The other question I see, do we get sales How do we get sales for other years? I think that is the same question. Which paper is this? I said April 2024, question number 4. Someone is saying this is my first time attending the class. Would it be possible to receive the recording from the previous sessions? I think, okay, I'm not the one who does. Maybe you can inquire from administration, but I think there was a guideline that there will be no, but just seek it from the administration to get the sales. That question about the sales, I hope the question on the sales have been understood. Those who are asking about which question it is and how we get the sales, I have think, yeah, someone has written paper is August 2024, question 4. Yeah. The only thing I can share for those who are asking that it is their first time, I can share the material, and I always share, and I hope they are distributed. Good. I don't know whether there is another question. It would be wise if you ask the question before we move. Before we move beyond there, before we move beyond that, I want to remember we are using the discounted cash flow method. So we need to determine how much the cash flows for each of the years. That is what I want us to get. The cash flows for each of the years. Once we get the cash flows for each of the years, then we can go ahead and discount. So if there is no question up to that point, I have tried to answer that question or to determine the cash flows based on the information actually that we have. Now, we are further told that the company, we have the cash flows, yes, for each of the years, but now there is another perspective to this question. If you read through note number 7, ML will retain an amount equivalent to 20,000 for internal expansion for first 2 years and 15,000 for the rest of the years. For the first 2 years, this is the amount to be retained amount. The retained amount means that they will earn this much, but we need to less a retained amount. The retained amount, we are told that they will retain 20. Is it 20 or 15? ML will retain an amount equivalent to 20,000 for each for internal expansion, yes, and 15. 20 for internal expansion for the first 2 years. First 2 years, yes, like that. We have this for the first 2 years. Then in the third year and the subsequent years, we are told that they will retain 15. We take the 15 for each of the years. What does this mean? It means that the cash flow that will be paid to the investors, this is the cash flow. I can call it the net cash flow. Net cash flows. Net cash flow is equal to, this is the cash flow that will be paid to the investors, to the shareholders. This cash flow, like that. That is the cash flow that will be available. Now, if we got this cash flow, remember we need to discount. We need to discount, but we are further told that at the end, this project is not ending, or this investment is not ending. There's somewhere we are told that, look at note number 6. ML is expected to grow by 10% per annum to perpetuity after the 5th year. Present value of cash flows to perpetuity. okay, the only reason that you may have an issue with this one is because we have not covered the discounted cash flow methods, what do we call it? The capital budgeting, but I will just explain this one briefly. We say that present value of, or let me call it cash flows in perpetuity, cash flow in perpetuity from year 2030, from year 2030. This one I will give a formula. I don't know whether you'll be able to see my, I want to insert a table, but I will give it on the other end. Let me use a table so that at least when you are revising, you will not be surprised where these things came from. I want to put it in a small table here. The present value of this cash flow, I'll say that this one is equal to 16,216.14. This one will grow by 1 plus R, 1 plus 0.1, the growth rate. We will be discussing this one in the capital budgeting. We need the discounting rate. Oh, we didn't determine the discounting rate. So allow me to first stop sharing so that I can explain the discounting rate. Stop sharing, stop sharing. I will share the Word document. Let me share the Word document. Let me share the Word document. Can you see my screen? So determine the cost of capital, costs required cost of capital, Determine the required cost of capital, which is the cost of equity. Cost of equity, because it is purely equity financed. We know that the cost of equity is equal to risk-free rate using capital asset price. Okay, let me go back to the question. Can you go back to the question? Let's go back to the question. All of you go back to the question. The introduction part of the question reads, Isonga Limited is a listed company specializing in the manufacture of leather products for more than 2 decades. It produces a variety of products such as bags, shoes, belt, carpet, wallet, gloves, and cushions. They are seeking to use advanced technology in producing and designing such products. The ML's cutting-edge technology has attracted the attention of the director of IL. IL is considering acquiring ML with a belief that it will use its technology to expand and be able to compete with the similar companies in the market. The company's performance in the past has been dwindling. Look at that part. The shares of ML, the one being acquired, is 15 million, priced at Rwandan francs 10.5 each. ML market value of beta, that is the beta factor of the company being acquired, is 1.54. The risk-free rate is 10%, and the market required rate of return is 12%. That is the point that we need to use to determine the cost of capital, and it would be prudent if I I did put it here. I can just put it here so that when pricing at least you'll be able to tell where we got it from. I will put that statement there. ML's market value of beta is 5.4, is 1.54. The risk-free rate is 10%, and the market required rate of return is 12%. So the risk-free rate plus return of the market minus risk-free rate, you multiply by the beta of equity. We can therefore say that the cost of equity is equal to the risk-free rate, which is 10%. This one we add 12% minus the risk-free rate of 10. We multiply by the beta of equity of 1.54. 1.54. Can someone give me the cost of equity from what you can see on my screen? I'm assuming you can see what I'm typing. Give me the cost of equity. That is the one that you'll be using to discount. Has someone answered? Just share your answer so that you can move. $13.08. That is what I see a majority giving, 13%. Yeah, so let me go by 13.08%. That is the cost of equity. That's the cost of equity. Now, after we determine, let me take the cash flow from the end that I was. Instead of using the table that I was introducing, I just want to do this. I want to carry my table here. Just allow me 1 minute. I take it from the Excel sheet, I bring it on the Word, and I want to make sure that it looks good. So there is a small adjustment that I need to do so that it can look good and it could be visible. In just 1 minute. Good. Let me press it here now. I say determine the cash flows. The cash flows. I will come and press it here so that at least you can see. Yeah, I hope it is clearly visible. I decided to put it that way so that at least you can see it clearly. Now, having determined that, I will use this section to determine, we say that the cash flows at the end of year 2029 is the present value of growing cash flows, growing cash flow from year 2030 at a growth rate of 10% in perpetuity. These cash flows, so let me give it this way. Present value of growing annuity in perpetuity is equal to annuity in the year just ended, in bracket 1 plus G divided by the discounting rate, which is cost of equity, minus the growth rate. This is the formula. Let me squeeze it together like that. And then, yeah, that way. So we said that 1 plus G. So this should be 1 plus G. I don't know, I skipped G. Good. So the A naught is equal to year 2029 cash flows, which is equal to, from our table, we determine the cash flow for the last year, and this is the cash flow here. So I'll give it as that. We also have KE is equal to 13.08%. We have the growth rate. The growth rate is given in the question. The growth rate is given in the question is 10%, which is the same as 0.1. What else haven't I done? Yeah, good. So can we therefore determine the present value? We said that the present value, which is equal to the terminal cash flow, is equal to that cash flow. We multiply this one by 1.1 plus 0.1, close the bracket. We add 0.1308 minus 0.1, like this, that way. Can someone give me this value, please? And something happened. Okay. I want someone to give me this amount. Okay, someone to share with me, someone to give me this amount, please. From your computation, 557.147.87, 579,147.857. I think it is something like that. Good, good. Just sum it up. Then I transfer it to the Word. Then I'll explain. Good, I have it now. Now, what we've done, we have determined the cash flow. I hope you can hear me. I hope you can hear me. Can you confirm that you can hear me, please? I hope you can see these cash flows on the Excel sheet there. Now, I want us to do this. I want to give you here, I will give you the years. I give year 1, 1, 2, 3, 4, 5. These are the years. Let me put it this way. Then here I have the cash flows equals cash flows. Cash flows, sorry. Cash flows. Cash flows. I will pick these cash flows. These are the ones that I'll be using. And there's something I need to do. I want us to have these cash flows for each of the years like that. That way. Then I want discounting factor. Remember, in the exam, you'll be required to use this one. So I will not compute for you. I want you to compute And the computation of this discounting factor, we say that it is, if the discounting rate is 13, we will take the one, okay, let me put it here. Discounting factor is 1.13, was it 08? 08 power negative n, power negative n. 1.138 power negative 1, power negative 2, power negative 3, power negative 4, power negative 5. I want you to give me those values. Give me the discounting factor. Share with me the discounting factor. 1.1308. I think it was 0.80 if I'm correct. Yes, it was so much. How much was it? Yeah, 13.08. So it is 1 plus R, 1.1308. That's basic for financial management or for corporate finance. Give me 1.1308 power negative 1, the power negative 2, power negative 3. Year 1, someone says 0.884. Let's go. Year 2. Give year 1, year 2, year 3, year 4, year 5. Year 2, 0.782. Year 3. Year 2, 0.782. Year 3, year 4, year 5. Year 3, 0.692. 6915. That's year 3. Year 3, I can see 692, 6916. Year 4 and year 5. Year 4 and year 5. Year 4, 0.612. Year 4, 6115. Year 5. Year 5, 0.5408. There's someone who has shared all of them. Let me put them equals 1.1308 power negative 1, and each of the years, but I'll give it in 4 decimal places. Like that. So I believe that is what we got. Then we get the present value. The present values is equal to the cash flow multiplied by the discounting factor, like that. Then we go sum them up. This is the total present value of cash inflow, which is the value of ML, value of ML. This is equal to, we sum it up, we sum up this, like that. That will give us the value of that firm, and that is what the examiner would be interested in. That is what the examiner would want you to determine. I don't know how many have a question. Is there anyone who didn't get it right? Okay, if we got it right, I want to make this one bold and underline it so that I can take it now to our Excel sheet. Good. Okay. Ask a question, please. Ask a question if there is any. Someone is asking why for year 5 we have used 16216. That is a good question. Why have we used the 16216? Each year 1 they generate 23, they generate 4, they generate 11, they generate 13, they generate 16. But from year 5 onward, this will increase. We need to get the present value of the future cash flow, and that is what we found to be 579. So the 579 we will add to 16 because we are saying from this year, the end of this year, to as long as we continue with the business, cumulative will be equivalent to this. That is why we have included the 16. We have included the present value of the future cash flow. We've added it to the cash flow at the end of year 5. We say that 579 is the present value at the start of year 6, which is the same as the end of year 5. I hope that question is answered, and that is what you are asking. We haven't used the 16. Yes, I have explained that. Is there any other question? I want another question. Is good. There it is. I brought it there. Now you can comfortably see it. Yes, the total present of the cash flows value of the ML. Now, I don't know whether someone has a question. We have determined the value of that farm, and that is what the examiner would have wanted you to determine for you to make the decision. Maybe the other thing, we need to go back to the question and see what did the examiner require. The question is, you have been approached by the director of ML to advise them on the maximum amount that they would acquire IL. We have determined the value, but now there is a market value somewhere. In the question, there was somewhere that was told that the shares of ML is 15 million priced at Rwandan francs 10.5. I want to capture this part. Let me capture it here so that at least we can explain it. Market value. The market value, we are told that the share of ML is 15 million priced at this. So total market value is equal to 15 million. We multiply by 10.50. Can you give me that? How much is 15 million times 10.50? We see how much is the market value. Someone can give us that, we see how much it is. Put it there, I need to see. 157,500, 157,500, 157,500, 157,500. Is that what you are getting? 157,500. I think that is what I see with the majority, 157,500. Now let's look at this. When you look at the question, the present value is 343 and the market value is 157. So we are pricing this company at 343. We say that the company ML is undervalued in the market. Therefore, it is worth acquiring it, but the maximum amount payable should not exceed its intrinsic value of 353 of 343,982. 343,982. 343,982.63. That is what the statement means, and that is what the examiner would have looked for. That question I've tried to give it what was best for it. Unless someone has a question, I don't think I have anything else that I can add on that part of the question. We can move to part B. Any question? I cannot see any. Let us move to part B of the question. Let me share the question. Let me share the question. Let me share this question. Who is it? Good. I hope you can see it. The last part of the question read, explain to the shareholders of ML the concept of agency theory. You remember our first topic, we talked about agency theory and discussed to them two causes and two solutions of agency problem. Let us read through this part. The relationship between managers and shareholders. One of the theories that have been pointed to explain why acquisition fail at a higher rate is agency theory. Shareholders of the target firm believes that the acquisition is in the interest of the managers of the acquiring firm. The shareholders of IL believe that the acquisition of ML will enhance the value of the companies through expansion of the market, improvement in sales revenue, and the reduction of the costs. The management of ML may act in the interest of the shareholders by taking defensive measures to protect the company to resist the acquisition. This might be done by maximizing the sale price of the company. You, as an expert, have identified a possible possibility of agency problem between the principal acquiring firm and the agent, which is the target firm. So the question is, explain to the shareholders of ML the concept of the agency theory and discuss to them two causes and two solutions. I just want to make it fast because this is something we have done before. I will just give the summary that I had given on my end so that at least we can move to something else. Good. Okay, there we are. I will use what I had prepared here. Agency theory. We need to look at it from this perspective. We already done it. Can you see my screen? Please let me know whether you can see my Word document, on the screen. Let me know before we start the discussion. Yes. Thank you. If you can see it, that is good. Let me go. I'll just take it the way I have put it. Agency theory explains conflict of interest that arise when managers, that is the agents, runs a company on behalf of the shareholders who are the principal, while managers control operations, shareholders own the firm. We say that. This separation often cause issues if managers are not monitored out. Managers may attempt to buy the firm. They manage conflicting with their role as agents acting in shareholders' best interest. The other one is empire building. Managers expand firms unnecessarily through mergers and acquisition to gain power and status, often without shareholders' benefit. The other one is creative accounting. All of them the way they are in our notes. Creative accounting, managers manipulate accounting policies and reporting inflated profit, such as choosing favorable stock valuation or depreciation method, potentially misleading stakeholders. Good. Now, the other thing that we need to ask ourselves, what are the available solutions for this? I've given so many of them. Solution to agency problem. Number one, performance-based compensation, aligning managers' pay with the firm performance through commission, bonus, and share option, incentive managers to act in shareholders' interest. Number two, threat of firing. Shareholders can dismiss managers for poor performance as seen historically in firms. All these are in the note. We've already done them, like the IBM and General Motors, motivating managers to align action with the shareholders' goal. The other one is threat of hostile takeover. You can decide to threaten them that if they continue to underperform, the firm will be sold. So we say that if a firm performance is poor, shareholders may sell shares to competitors, leading to management dismissal or loss of influence. This threat encourages managers to avoid action that devalue the firm. To the best of what we had, I think I have explained merger and acquisition. We've looked at illustration, we've looked at questions, and I can comfortably say that I am happy. We have finished the second topic success-free. So far, we have done 2 topics. My objective was to finish a topic each week. So today's topic the third topic ought to have started today, but we had to finish that merger and acquisition. I don't have any doubt that we will finish this week's topic because I decided to go for a shorter topic, and this is what I want to introduce. Let me introduce the next topic, which I will call corporate failure. Let me put it well so that we can start. Good. If you can see my screen, I want to explain the topic corporate failure. Corporate failure. Before we start that, I want to take a commercial break. I want to give you a commercial break of 5 minutes. 5 minute commercial break. Take some water. You come, we continue from there. We are on break. 5 minutes. There is a niche. They only appear and reappear because we agreed we take a short break. So someone asking whether the class is not there, that can tell you that they were not in. So let us, someone is asking, is there any chance to go back to merger and acquisition, especially on particular parts? Okay, I don't know what you mean, because when you say particular, I don't know what the particular you are referring to. I don't know what you mean on particular. I want us to continue. I hope you can see my screen. We are looking at corporate failure. Corporate failure. Within the remaining time, we look at the corporate failure. Tomorrow, we will finish it. This one is not very wide. It's actually very brief. So what is corporate failure? It is that factor that will make an entity to go down, but there are some things that we need to understand. I will take you through what I have written. I've made it very summarized so that at least we can understand. When it comes to the corporate failure, that what will make an entity, a running entity, to come down or to cease operation, to be unable to operate. Let us try to understand financial distress and corporate failure. A financial distress, this is where the firm is in difficulty to meet its financial obligation, like paying salaries. It is unable to pay creditors, or if it does it, it does it with a very difficult environment. It's difficult paying salaries in arrears, meeting the creditors' obligation in arrears. So we say that financial distress is a state where a company faces difficulty in meeting its financial obligation to creditors and other stakeholders due to lack of liquidity or profitability. It is a prosecutor to the corporate failure, and in extreme cases can lead to bankruptcy. That difficulty in meeting your financial obligation. So what are the characteristics of corporate failure? Number one is liquidity problem, inability to meet short-term financial obligations as and when they fall due. So we are saying that the corporate failure, the liquidity problem, you may want to meet your financial obligation, but it become difficult. It become difficult because you do not have the cash flow. The other one is declining profitability. The declining profitability, it is an issue to do with the profits are going down. If the profit margins, the operations, you find that there is a diminishing profitability. The other one is high financial leverage. The high financial leverage in this case, we are saying you have a lot of debt in your capital structure that will overburden the firm. So high financial leverage, excessive use of debt. When your debts are too high, you are likely, that one is an indication that you are headed for financial distress. The other one is when the risks are so high, there are so many facing the entity, high degree of business risk, often due to high fixed operation costs. There are risks that employees will quit. You see that these are risks that will affect the business. The other one is legal pressure. In case you are dealing with a lot of legal issues, such legal issues deplete the confidence that other parties would have with you. Those who are willing to do business with you may not be willing to do the business. They may not be ready to do the business. So the legal pressure. So we are saying that the financial distress, if well managed, if it is well managed, you can withstand. But see, in most cases, when you're in financial distress, the entity is likely to go down. But there are strategies that you can use. You could sell off the entity, you can do the restructuring, you can do merger and acquisition, all that to save the entity. Financial distress. On the other end, we look at the corporate failure. The corporate failure, by definition, is a complete cessation of operation. The company is unable to continue, it goes down. We say that the company ceases from operation. It is the final outcome of unresolved financial distress. If you do not manage the financial distress well, the entity will go down. That is one thing that we need to understand, and I think that is clear. The other thing that you need to understand is, or something else that would be asked, is what are the symptoms of corporate failure? What are that? What is that? When you see in an entity, you know that the entity is facing corporate failure. The examiner will tell you to give the symptoms of corporate failure. Number one, it is financial symptoms. One, consistent operating losses. The company makes a loss this year, next year, like that. That tells you that this company is faced by a failure. Deteriorating liquidity ratios. Your liquidity ratios continue going down. Cash ratio, quick ratio, the current ratio, they continue going down automatically. That will result to the failure, or it is an indication that this firm is headed to a failure. Increasing debt, you get more debt, you borrow, you keep borrowing. And these are things that you should also try to relate in your personal life. Are your debts going down or they are increasing? You wake up one year, you have debts. You wake up another day, the debts are increasing. Did I see someone say that my screen is not visible? Let me check. Oh, the screen is not visible. Sorry. I don't know how it disappeared. I thought I was sharing. Okay, fine. Thank you for those who have communicated. I hope it is visible now. Please confirm. Please confirm that whether the screen is visible. I cannot see 4 students. I don't know where they have gone. You were 100, and now I don't know where the 4 have gone. Yeah, now it is visible. Yes, thank you. Can someone tell those 3 students who are not in class to come back? Good. If it is visible, let us continue. I'll keep checking when you are posting something. So we are saying that the financial symptoms of corporate failure, operating losses, liquidity ratios continue to deteriorate, continue borrowing. The other one is negative or declining cash flow from operation. We know that when you determine the cash flow, we get cash flows from operation, cash flow from financing, cash flow from investing. If your cash flows from operation are going down, the one for financing are increasing, then you are living on capital cash flows. The one on investing are increasing, then it means you are liquidating your business. Diminishing cash flow from operation is an indication. Delayed payment to suppliers, that is the liquidity problem. You are not able to pay the suppliers. The other one is increasing difficulty in securing new financing. When the assessment by the lenders indicates that you don't qualify for more loans, then it tells you that they have also detected a failure. Then misreading or manipulated financial statements. When you see an entity start preparing manipulated financial statements, that one should tell you that there is a problem. Operating symptoms. One, loss of market share to competitor. When you see that new competitors are coming, they are taking up your share, that is an indication of possible corporate failure. The high employee turnover. When you see an organization, employees turnover is very high, employees are leaving the firm, that is an indication. Productivity decline and quality issues. Sometimes you offer quality that is compromised because we know that quality goes with finances. So when the finances go down, you don't get the right quality. That is another indication. Then we talk of failure to innovate or adapt product to market changes. You are sticking on the one strategy, no innovation, ineffective marketing and sales strategy. You are making sales, marketing, but these strategies are not effective. The overly complex organizational structure. Sometimes when things are bad, you don't know who is the CEO, who is the manager, who is the cleaner. Very complex organizational structure. This is an indication that there is no clear procedure to running that company. The other symptom of corporate failure is management symptoms, incompatible or dysfunctional management team. Organization has a management. If you ask one of the employee or in the management what their goal is, they don't know. They rarely communicate. No meetings are held. Lack of clear business strategy and vision. Then we talk of the poor decision making by senior management. Sometimes you look at the decisions that are made by managers and you wonder whether they are really competent. So I hope all these symptoms, you are trying to relate them with where you work. You see whether there is a problem. The other one is one-man show, where only one individual makes a decision and their decision is final. That is an indication of management corporate failure. Ignoring market signals and customer feedback. The customers are telling you this, but you continuously ignore them. Poor internal controls, there is no accountability, no one is responsible. These are things that can indicate corporate failure. What causes the corporate failure? What is that will make the firm to go down? It is a combination of a number of factors. We could have the internal and the external. Let us look at the internal causes that are within the control of the management. Number one, financial mismanagement. You find that there is poor working capital strategy. If you remember when we started, we said that the finance manager has an objective of working capital management. If there is a failure in working capital management to balance between the current liabilities and the current assets, to know how to finance, you find that working capital is financed using long-term debt, automatically that can tell you there is a problem. That will cause problem. The other one is over-investment in non-current assets that do not generate adequate returns. I will mention this one on individual level. I will not say much because people don't like to hear it. But I say it because it is how it is. Look at this. Over-investment in fixed assets that do not generate adequate returns. When you take your money, you go buy a very big home, that you'll pay over that years, your lifetime on earth, automatically that one will put you in a very bad financial position. That is from a point of view of your life. If you are making such a decision for yourself, can I trust you as a manager? You are likely to make such bad long decision. Investing in non-current assets that do not generate any revenue. Invest in assets that give you income. Out of that income, you go and buy that asset. This is a mistake. If you look at many organizations, look at the like universities that have gone down. They go buy very big buildings that so as to show that they are growing, but they are not generating anything. They end up going down. Investment in assets that are not generating a return that can reflect the performance of the firm. Excessive borrowing or poor capital structure decision. It is the duty or the role of a finance manager to give optimal capital structure. If the manager failed to do that, the firm is headed for a failure. Inability to meet financial obligation, the long-term financial obligation, that is another thing that can lead to corporate failure. The other one is operational inefficiencies. The operational inefficiencies and acquiring assets that do not commensurate the investment, that do not give what is expected, that is suboptimal utilization of the asset. Let me give you another truth that hurts, because we are not only learning this one for the purpose of exam, neither are we doing it for the purpose of our employers. We should do it for the purpose of our life. I am here. I am on a 30 years mortgage, so I'm living on a borrowed house. I am driving a car on loan, a 6 years loan car that I drive from home to the office. The car spent the whole day not generating anything but parked somewhere very safe, and it is on a loan. That is what we call suboptimal utilization of assets. Instead of that asset generating, I would rather, if it is on the loan, I give the taxi guy immediately I get to my office so that it can help me to repay the loan. This is the kind of the thing that organization does. You are there, you advise the organization to buy the manager's vehicles that do not generate anything, and they are on loan. You have so many assets that are underutilized. You have a building that is 40% occupied and you want to acquire another one. First, utilize the one that you have to optimum. Then you go invest on another one. Operational inefficiencies. Failure to control costs. Sometimes you look at an organization, the number of employees that are there, it's just bloated. Inefficient production and supply chain management. The process of production, a lot of wastage. That one will lead you to failure. And this is not only in the private life, in organization, even in government. A lot of resources that are put in the government and which are not beneficial to anyone. Inefficiency, that is bloated expenses, the costs that we incur as government officials, traveling all over the world for benchmarking, where it is something that you can get in the internet. You want to go and see a dam that is in Ethiopia, a big dam that is in Ethiopia, something you can see from the internet at no cost. So these are the things that we are talking about, inefficiencies. They are likely to lead to corporate failure. Strategies and marketing deficiencies, lack of clear and adequate business strategy. In every business, if you do not plan, you are planning to fail. That is the simple definition. Failure to plan is a plan to fail. Lack of clear and adaptable business strategy. Failure to conduct adequate market research. Before you go out there to market, can you do the research? Losing market share due to outdated product or poor marketing strategies. This is something that is ailing many organizations. Like in this era of technology, you are doing things the old way while everybody has converted into the new way. That is something that is making so many organizations to fail. And a good example is what happened to Nokia. In early 2000, Nokia became into the market as a very big company, promising company. When the telephone system changed to Android, Nokia remained on the button phones. That is how Nokia went down. When the CEO was asked what happened, he said, we did everything right. We don't know what happened. We found ourselves out of the market. It is losing market share due to outdated products or poor marketing strategies. You are supposed to know that in such a case, you are headed for failure. The other one is human resource problem. If you have a long reader, I can tell you are doomed to fail. You look at the countries that have succeeded. Look at a country like Rwanda. It is because of good leadership. Some other big economies have gone down because of poor leadership. The same case even in organization. Organization, depending on who is leading the leadership, it determines a lot whether the organization will fail or succeed. Personality conflict within management, where people are ever conflicting and fighting, that is another thing that can cause corporate failure. Underutilization of employee skills and talents. You go to an organization, they have 10 accountants, work that can be served by 2 accountants, underutilization, and you are still paying them. The other thing is the issue of corporate governance, lack of well-functioning independent and active board of directors, the board of directors that is influenced. It is not independent in decision-making, manipulating of account to hide poor performance. That is governance. Those are the internal factors that can cause failure. I want to see whether someone has a question. Ask a question on internal factors that causes corporate failure before we move to the external. Someone is saying go back. I don't know to what extent. Just ask a specific question because I may not know to what extent I need to go back. You say go back if possible. Please just be specific because I may not know to what extent. Okay. Okay, is there any other question? Please clarify on to what extent do you want me to go back, or have a specific question. Now let us look at the external causes of corporate failure. One of them is economic factor. Sometimes when the country is facing economic downturns, it is likely to affect businesses. When the inflation and lending borrowing rate is too high, maybe you borrowed at 15%. The interest rates are continuing increasing, they're at 30%. You had borrowing knowing that you would pay, then you find yourself in trouble. That is a factor, interest rate, inflation. The other one is change in government policy. Sometimes the government policy can be unfavorable, making you to fail. Like the government may wake up one day and say that there should be no private schools, and you have invested in private school. They direct all the government officials to take their kids to public schools. And those are the people who are employed. You are targeting, automatically it will affect your business. Market and industrial factors like intense competitive and price wars. Sometimes entities go down because of price wars, very high competition. The other one is change in consumer taste and preferences. Like in this era of technology, if you're in tech, you should always be prepared. What do the consumers want? The other one is technological disruption. We know the change in technology. Then we talk of unavailability of key raw material. Maybe there is the input you put in your organization, you use in the farm, but again, you find that the materials are not there. Maybe you are importing some inputs from a country, let's say Ukraine and Russia, then they get to war, automatically you will not have the input. The other one is unforeseen events like natural disasters that can cause failure, theft, fraud, and cyber attack. The issue with the cyber attack, this is something that, in fact, I have been doing the corporate cyber attack or cyber security the whole of this week for the Central Bank of Zambia. And I can tell you cyber attack is bringing many people down. Cyber security, the best way is to call it cyber security. That is something that is bringing so many organizations down. The issue to do with fraudulent activities and misappropriation within the organization, that is another problem. That is it. The other one is global events. During COVID, many organizations closed down because of things that happened, like pandemics. So that is another cause of corporate failure. Then we go on with avoiding corporate failure. What do we do to avoid corporate failure? And you will get these questions in the exam, the theory part. You will get these questions in the exam. Just make sure that you understand. If you have a question, you can ask. Let me check whether someone has asked a question before I continue. Okay, good. I see people asking questions. Let me see. Let me see. Someone says, how to resolve these internal causes of corporate failure? A good question. How to resolve this internal? That is the same question. Theft, fraud cannot be internal causes. No, theft can be both internal and external. We can have it from internal. We can also have it from external. The question is how to resolve these internal causes of corporate failure. Let's look at this part of avoiding corporate failure. I will explain that question from that perspective. Your question on how to resolve these internal causes of corporate failure, I will try to explain them from this point. The other one, that one of theft can either be internal or external. Yeah, so I think those are the only questions. Let's continue. Avoiding corporate failure, I will respond again to the person asking how to resolve this internal. We look at both internal and external. Number one, we talk of the proactive measures and responsible management approach are critical to avoid failure. One, strategic and financial restructuring. Restructuring operation, that is streamline business processes, selling off unproductive assets, and discontinuing non-viable project. You see, that is an issue of internal. You buy so many assets that are not productive, sell them off, dispose them off. They are not productive, they are not helping you. When you find you are driving 2 cars on loan, just dispose one instead of affecting your productivity in office because of stress. Dispose that asset that is not productive for the organization. Financial restructuring, you can negotiate with the debtors to issue them equity so as to minimize the equity, the leverage. The other one is operational excellence. It is still internal cost management. Implement a rigorous cost reduction program, such as layoff. Embrace technology. Some of these things, you don't need to engage people who are expensive. You can go for technology. Try to manage the overheads. The other one, be innovative. Stop using the old ways. You see, you cannot sit there, do things the old way and expect that you'll make profit. For example, if you are managing a bus company, we know that we are turning to electric vehicles, which are cheap to maintain, although expensive to procure. Sometimes it will call for change because maintenance of that vehicle is a diesel or a petrol vehicle is expensive, but the electric one could be cheaper. So you need to look at, be innovative, come up with good strategies, customer focus. Look at what the customer want and listen to the customers. Listen to your customers. Don't force yourself to customers. They will leave you. The other one is improvement, management, and governance. Strong leadership. If the CEO is of integrity, the organization will move. If the CEO is of questionable integrity, the organization is in trouble. The finance manager, maybe you hired your friend. You didn't hire competence. Improve on leadership. Effective control. Put robust internal control systems. The other one is active board. Put people who are working, not people who are there to earn allowances, people who are working. Get people of good integrity, ethical practices. Make sure that there is that good governance to practice good ethics. The other one is employee engagement. We know that employees are very resourceful if you engage them. If you don't, you will continuously lose. So we say that talent management, organization to meet employee needs, fostering positive work environment, and retaining the talented ones. The other one is environmental awareness, staying informed and reactive to changes in the economic, political, and technological environment. You should look at what is happening outside there. And that is the part to do with the corporate failure. Now I want us to look at the predicting corporate failure. But if you have a question, I can respond. If someone has a question, please ask. What about lack of skills in leadership in corporate failure? This cannot cause corporate failure. Are you saying it cannot, or are you asking whether it can? Number one, how do you learn a corporate with unskilled leadership? Either by wisdom or by knowledge. Skilled managers means a lot in an organization, in corporate success. The reason that you find that if a CEO is not very well educated, they will always fear those people who are educated. That is something that need to be well thought about, because we need skilled people, experienced people. Organizations with well-skilled managers or leadership are likely to survive. So your point is good, because lack of skilled leaders can cause a failure in an organization. Any other question? Good. Can we go to predicting corporate failure? We go to predicting corporate failure. I appreciate the fact that you are almost all in for the class, and I believe you are following. Although I know that I am moving a little fast, when I'm explaining theory, I don't like to take a lot of time. It could be boring. That's why I'm moving fast. Predicting corporate failure, we will be looking at the quantitative and the qualitative measures. And one of the quantitative measure is the predicting using the Altman's Z-score. And that is what I'll be explaining, what it is and how we predict corporate failure. Predicting corporate failure, I want us to say that these are the measures that can help you to know whether the entity is headed for success or it is headed for failure. So predicting corporate failure is a critical aspect of financial management, providing early warnings to management, investors, and creditors. Model designed for their purpose can be broadly classified into two groups, that is qualitative and quantitative. The quantitative relies on financial data, while the qualitative is on non-financial factors. Both of them are very good. Like an organization may experience high labor turnover, irrespective of it paying its employees. That is a qualitative. You need to ask yourself, why are the employees leaving the organization? Good. Let us start with quantitative. The quantitative involve the financial data, and one of the methods that is commonly used is the Altman's Z-score. So quantitative model use historical financial data such as ratios from company's income statement and balance sheet to predict the likelihood of the financial distress or bankruptcy. The most famous example is the Altman's Z-score. In my duty as a consultant, I have used the Z-score in reality. So I'm telling you the real. I've used it in reality to assess the likelihood of the company to survive, and it gives a good basis for advising the investors. Altman Z-score. It is a 1968 model by Edward Altman, a professor of finance in New York University. We say that it is a tool to predict corporate bankruptcy. The model primary objective is to assess company financial health and its probability of entering into bankruptcy within 2 years. What does that mean? I want to explain before we get to the nitty-gritties. We say that Altman combined so many ratios, and he came up with what we in the modern world we call the Altman's Z-score model. According to Altman, a firm will fail if it fails to meet a certain Z-score criteria, and this is what we'll be looking at. So what are the features of Altman's Z-score? One, multivariate analysis. You see, I said it uses a combination of ratios to come up with a summary. It will look at liquidity, the profitability, the leverage, the activity ratio, bring them together and come up with what we call the Z-score. So the Z-score is a multivariate formula that combines 5 key financial ratios. This approach is more robust than using a single ratio, as it captures multiple dimensions of the company's financial state from liquidity, profitability, gearing, that is the leverage, solvency, and activity. So these are the things that we need to look at under the Altman. When we say that it is multivariate, it captures multiple ratios. Number 2, It is practical in application. As I said in reality, for me, I have used the Altman Z-score in my duty of consultancy to help some company understand their status. It is real, it is very practical. Z-score are widely used by analysts, creditors, and academics to assess the financial distress of companies. They provide a simple, easy to calculate and control measures for evaluating corporate health. Now, let us look at what we call the Altman. The Altman Z-score formula. The Altman Z-score formula, I want you to look at this formula, this one. Let me make it bold. Let me change the color for visibility. The examiner may not give you the formula in the exam. The original formula for predicting a traded manufacturing company is Z-score is equal to 1.2x1 plus 1.4x2 plus 3.3x3 plus 0.6x4 plus 1x5. What are these x's? x1, x2, x3, x4, x5? I hope you can see my screen. I want to make it even bigger for visibility and clarity. I want to give you what is the meaning of these x's. X1 is a ratio of working capital to total assets. It helps to measure the liquidity, and we say that the higher, the better ability to cover short-term obligation. More of working capital is better. It helps to assess the liquidity. Number X2, we say that it measures the cumulative profitability. Remember, we are talking of the retained earnings over total assets. So it is cumulative profitability, that retained earnings that have been built over years. That is the one that we are using to assess the cumulative profitability. So it indicates how much profit has been reinvested. Other firms generally will have a higher X2. X3, we say that earnings before interest and taxes over total assets. Now, one thing I want to note for you to understand it is that everything is over total assets except X4. So X3 is earnings before interest and taxes over total assets. It measures the efficiency in operation, the firm's ability to make more return on the assets invested. Then we have X4. It is the market value of the equity shares over the book value of the total liability. This one measures the gearing of the firm, the leverage. How much of equity is in the firm compared to the total liabilities. So it measures the leverage. A higher measures more equity buffer to cover debt. The last one, X5, is sales to total assets, which is, it measures the assets turnover. How much do you generate once you have invested in the assets turnover? Of the 5 ratios, all of them have a base of total assets. So how do you understand them? Working capital 1, retained earnings 1, EBIT 2, 3, market value of equity 4, and sales 5. All of them over total assets except X4, where we have the market value of equity to book value of total assets. Now, having that in the Altman, we need to do the interpretation. Once you have computed the Altman, what do you do with it? We say that Altman Z-score help to analyze the likelihood of a firm to succeed within 2 years as a result of bankruptcy. Interpretation number 1, if the Z-score is greater than 2.7, that firm is stable. it is stable. The company is considered to be financially healthy with a low probability of bankruptcy. Once you compute the Z-score and it is greater than 2.7, it is a good firm. If the firm is between 1.8 and 2.7, we say that it has 50-50 chances. It may or may not fail. The company is in ambiguous state. A caution is advised. There is moderate probability of financial distress. It may fail, it may succeed. It is on a way scale, may or may not. That is between 1.8 and 2.7. The last one is if Z-score is less than 1.8. This one is telling you that the firm is financially distressed. This one is going down. The company is significant financial distress with high probability of bankruptcy within 2 years. A firm at a Z-score of 1.8, that one is going down unless there is a miraculous or a very big shift happening. Tough decision being made. So we got the three perspectives, but in some other breakdown, people can try to break down into different, but that is the basis for the Z-score. Limitation of Altman Z-score. What are the problems of Altman's? One, it was originally developed for publicly traded manufacturing firms, so its applicability to other industries, e.g. service, financial, private held companies, can be limited. Why do we say that? If you look at X4, X4 is market value of equity over the total debt. The question is, all companies are not listed to know their market value. That is one limitation. Number two, the model relies on historical data and may not capture sudden changes in the company financial condition. There are companies that could be failing as per the historical data, but there is a shift even in market or in other factors that will be favorable in the future. So it is based on historical data. The other one is that the model does not account for qualitative factors such as management, quality, corporate governance, or industry-specific risk. The reason we say that is because a firm could be failing because it had very poor board, very poor CEO, but because it has changed and you go do the assessment, it will not capture the quality of the leadership. It is more quantitative, ignoring the qualitative factors. We will be looking at an illustration for that. I just want to finish the theory part. Government intervention in corporate failure. Well, the government can intervene, but how many times will it intervene in the private sector? In case the government intervene, it may intervene to salvage the situation because we have seen government intervention like giving grants to salvage the situation. That is possible. There is a book I read and found different bracket of Z-score. Yes, I said, I think I have mentioned that there are so many definitions of the Z-score. There are so many definitions of the Z-score, but you will see that they range between 2.7 and 2.7 and 3. 2.7 and 3 is the higher, but from the Altman, we talk of 2.7. 2.7. But still you find breakdown ranging around that. So that is not something that can affect your decision or your response, but I would advise stick by 2.7 for exam purposes and 1.8 for exam purposes. Above 2.7, healthy, between 2.7 and 1.8, gray area. Below 1.8, distressed farm. So I know there are so many that will come up with different quotation. Stick with the standardized one. Yeah, stick with the one that I have given. But you'll find so many others trying to give some margin and some other justification. What about government intervention? I think that is the question that you've answered, that the government could intervene and salvage the situation. Allow me to look at qualitative. It's not too much about qualitative. Yes, let me just do the qualitative so that when we meet tomorrow, we will look at a question. I hope everyone is in class, except those who are asleep, because I have noted there are people who come to class to sleep, because sometimes I say that we have finished the class, then 15 minutes later you see someone writing, the class on, we cannot see I don't know what. Can you concentrate in class? Because this is something that I've noted. Someone just turned on and left for their business. Then when they come back, they are like, oh, we are not learning. And it is someone who went to their business. So can we move together? Qualitative factors. These are models that are non-financial, and they look at the other factors, the quality of the management and the other factors. So they are often based on internal assessment and seek to identify non-financial characteristics. The key factors of qualitative model are: 1, management competence and integrity. Someone had mentioned in the question and answers, asked about the management skills. This is where we say that when you assess the organization and you realize that they have management of questionable integrity, that one should inform you that you are headed for a rough road. So assess the skills, experience, and ethical standards of the leadership. Number 2, business strategy. It is good to have clarity, viability, and adequate adaptability of the company long-term strategy plan. Some of the organizations do not have long-term strategic plan. They are likely to have a problem. Corporate governance, that board, the leadership, the accountability, are they responsible for the outcome of their decision? Governance. Market positioning, the company competitive advantage, market share, and customer base. Do you have customer base? Are you enjoying the market? Does the market recognize your presence? That is another thing. Industry trend, the overall health of the industry, technological changes, and competitive dynamics. Can I tell you something? Industrial trend. We are accountants. I want to give you an advice on this one before you find yourself corporate failing. If you are corporate yourself, please, if you are an accountant, can you embrace technology? Because technology will send many accountants home. Take accounting, that is paramount. But don't take accounting only. Take technology, a unit in technology. So many people have gone down because of their good relationship with the technology. At least take a course in technology so that you understand when you talk of the use of the artificial intelligence in accounting, you know what it means. And the reason I tell you that is that one thing that I can say I'm proud of, I did my IT immediately after completing my accounting. And I can tell you it is a competitive advantage. Please, if you don't want to, if you understand the industry trend, and I will give you an example. Today, look at the accounting softwares that are in the market. Most of them are developed by IT people who do not have accounting knowledge. This is something that I've come to learn. The softwares that you have in the market, they are done by the IT people who do not have accounting knowledge. I decided to do one software which we are releasing in the next like 1.5 months. An accounting software by accountants. It has a complete difference. So you will be pushed out of the market by the IT people. Industry trends. As an accountant, can you study and see that the world has gone technology? Take accounting and the IT course. That's just my advice. It is the same case even in business. When you take a business and you don't embrace technology, you are doomed to fail. Operational efficiency, the quality of production process, supply chain, management, and employee relationship. We talk of the production process. We are getting to a world where just in time is a reality. Just in time. Outsourcing in place of manufacturing is a reality. These are things that you look at operational efficiency. This will help you to understand. If the farm does not lack operational efficiency, it is not sensitive to industrial threat, automatically you don't expect much to happen to such a farm. I don't want to introduce this illustration before this time because we may not finish, but I will be looking at this illustration as I try to explain the other factors of qualitative models. I want us to leave it at that. When we meet tomorrow, we will wind up this topic and I will be very happy having achieved my objective of finishing a topic every week. We will finish because I want us to have some time towards the end, the very last lessons, to do revision. Let us leave it there unless someone has a question. Unless someone has a question, I cannot see any question. I think I have answered. Okay, I think they are there. Thank you for the support. The ICPAL study material says something about score model, attributable against that mixed model. What does it say? I think you should have given us. We are following, thank you. What about government intervention? That one we had seen it. You will see, you will agree with me that the difference in that prediction is very insignificant. Yeah, it is very insignificant. So let us leave it there. Have a great evening. See you tomorrow.